365. Yo, shake my hand and welcome to another video, and technically speaking the first video in the series that I want to try out with you guys. It's very important before I start, if you like this type of teaching, this type of approach, this type of pedagogy to financial markets, and you want to see more videos like this, let me know in the comment section, hit the like button, etc. I want to go through with you guys my favorite book of 2021. I read it in 2019, reread it again in 2021, spoke a lot about it last year in 2022, and we're talking about Adventures of a Currency Trader, a fable about trading, courage, and doing the right thing by Rob Booker, published by Willie Trade. And if you get a book published by these guys, just know, it's a really good book, right? And I want to nitpick a few segments, a few sections out of this book as we go by in this series. I'm going to try and keep the videos short and succinct. And today's lesson one from the book is learning to ride your profits, right? So, if you want me to read the entire book to you, that's a whole different thing. We can do that on the 365 Money Heist podcast. You're going to let me know. But for this particular video and this particular section of things, I'm going to be just picking out some key lessons throughout the entire book. And the first one that I think holds significant value starts from page 35. All right, so on page 35 of, once again, Adventures of a Currency Trader. And remember, not remember, let me just give you some background information. The protagonist in this entire story is himself, Rob Booker, but as obviously a character in the book, and he's just figured out about trading. Number one, he buys this bot, like an old school mechanical robot, and it's losing money. He's in and out. He sees profits. The whole journey, the whole first 2 to 3 years of any retail trader's journey, right? But this guy is in it deep. The greed, the emotional intensiveness that he brings to trading, the poor trading psychology, the poor trading training. He's lying to his family. Eventually, later on, we figure out that he's going to lose his job because he's really focused more on this little a robot. He gets margin called left, right, and center, but he actually works for a law firm, and his law firm has a financial side of it that actually runs a trading floor, and an investment firm for big clients, right? So he starts to meet professional traders, okay? And the first big trader that he meets, his name is Craig, in the book, and Craig is giving him like a background lesson on a $10 million lesson, a $10 million trade, and how it went. So what I want to do is I want to quickly read you just a couple of lines, a couple of pages. We're going to go through it together. It's only going to be about 4 pages, and I really want to extrapolate, some key issues here. All right. So lesson number 1, learn to ride your profits. This is actually important, especially for swing traders. A lot of times you get into price and you get out too quickly, and you think, fine, you've bagged 1:3, 1:2 in terms of risk to reward ratio, which is great. The problem is, in your original analysis, you got into price based on a trend. Well, a trend is going somewhere, and getting out of a trend too early might mean you get to take profits today, but it also means for the next 2 weeks, 3 weeks, 4 weeks, 6 weeks sometimes, if price becomes parabolic, right? And we've seen a lot of parabolic charts. We've seen Euro, TRY, Euro, Swedish Krona. There are many parabolic pairs, and Bitcoin went parabolic at the beginning of the year, where once you're out of that trade, it's almost difficult to get back into the trend that's still moving in the same direction as your analysis, still moving in the same direction as the way you understand structure, especially if you're a supply and demand trader. The way we look at charts and look at the markets, we already know that price is a predetermined destiny, right? It's going to a specific place. If it's leaving a demand, it's going to a supply based on a higher time frame analysis. And so when you get out of price too early or quickly, we have to really break this thing down. There's a difference between understanding, right, the trend and when it's most likely to turn against you, and it will always turn against you at the impact of institutional order values, right? And it's something I preach on this channel all the time, right? So banks preset their orders ahead of time. We can see this stuff in COT data. We can see this stuff in how we line up our structure. We can see this stuff when we talk to floor traders. We can see this stuff when we look on the Bloomberg servers, right? Institutional money is not random, it's very organized. Retail traders, extremely random, extremely disorganized, and that's why they lose. And so if there is a mapping out of where price is going to go, banks think in 3 months, take profit in 1 year, in a 10-year plan. You've heard me repeat that many times. What happens is we get poor trading psychology information. For example, holding on to a trade for too long is a sign of greed. That is not trading psychology. That is not the definition of greed in the markets. The definition of greed in the markets in terms of trading psychology is entering a bad trade, is entering against your trading plan, is not exiting when you're supposed to exit, sure. But where are you supposed to exit? Especially if you're a swing to positional trader. You only exit at the next turning point, right? You don't just get in and out of price. That's issue number one. Issue number two that I hope the book, in the 4 pages I'm about to read to you, that's going to extrapolate, is that you're not always going to get the chances in the market to re-enter price. There's only sometimes 1 or 2 good valid demands, and then price runs for 2 to 3 weeks, right? Entering anywhere else is fundamentally 99% reason why you get stopped out, because you enter price when you want, you enter price at support levels, you're not really mapping out the correct safe entry points. And so when you miss a key entry or you get out too early, you are parked. You're parked by the side as the train leaves you, all right? And then you have to fight those trading psychology demons that force you to get back in. So now you're getting back in, you're breaking a lot of trading rules, you're breaking your entry, your entry protocols in price, because you realize that, yes, I made money yesterday, but the trend is still going, price is still going up, let me buy again today. And that's when you get cut to the knees. And so Craig is about to teach Harry is the protagonist in this book, an important lesson about learning how to ride your profit. So it's a dialogue between the two, and like I said, it's not a lot. It's only about 4 pages, all the stuff that I want anyways, and I really encourage you to sit through this stuff. And if you like this type of content, you'll let me know, right? So I'm going to begin at page 35. So Harry is me, and then Craig is Craig. So I'm going to be Harry and Craig, right? So Harry says, you said that at first you were not successful at trading, but John told me that you had a trade on the euro against the Japanese yen that Addison took for you. So Euro JPY. Craig says that's true. That one trade made $10 million for the firm. Harry, John told me it was 5 million. No, that's not correct. Addison at first bought 5 million euros on that trade, but we made a little over $10 million on the trade when I finally got out. I knew that the euro was falling back to a solid point of support on the charts, and I knew that the economic outlook for the Eurozone economy was much brighter than it was for Japan. So he's basically working him through the fundamentals, right? Which was still in a huge economic slump, and it set interest rates at an unbelievably low point, which is a story of JPY. It always has been, by the way. JPY loves low interest rates for a good reason, right? After a brief move downward, Euro JPY was ready to pop upward. I had been doing my homework, do your homework, calling around to other young traders that I knew, and we were all convinced that there was no way the currency pair could break and stay below 119. Right, this was late September 2002. I didn't have any secret information, but I was convinced I was right. Harry says, how did you know you were right? Mostly, Craig says, it was my own research. Besides what I've already told you, I called some analysts around Wall Street, asked them for their opinion on the pound against the yen, the Swiss franc against the yen, and the euro. Everyone was telling me that there was going to be a sharp sell-off that would end soon. They sent me some charts that confirmed what I already suspected. 119 was a technically important barrier. Price had a hard time breaking above it in the first place. In fact, in the first week of 2002, 9 months before, look at him, he's thinking in financial quarters, right? You guys really need to get used to reading higher time frame analysis. You can't see 9 months before in your 1 hour chart. You're lying to yourself. You got to go through your daily, weekly, monthly charts on a regular, right? So 9 months before, price had hit the same level and fallen back 300 pips or points in just a few days. It took 9 months and 2 weeks to finally break above it. But by then, right, and by the way, here he's just illustrating the power of looking left, right? Before you make a decision on your charts, always look left. Look at the historical data, right? Back test the next trade you want to take, sell or buy. Back test it, see if it makes sense. Look left, right? So then he says, by then, it was the last week of September and price had risen to 122. And on that day that Addison sat next to me, price was nearly at exactly 119, where you wanted to buy. Harry says, me, well, and that's how you knew you should buy. Craig says, oh, heck yes, for sure. I wanted to put my own money in this trade. I told Anderson all this. He didn't say a word for the entire time. Just listened to me, make a speech. He didn't even ask any questions. Anderson is their floor trader manager, their supervisor. So if you professional floors, it's what I do for my floor trader. Someone who manages your stop loss for you, even though you manage it. But if they feel like you need to get out, you get out. Someone who's going to, keep your targets true. Someone's going to supervise your trading plan. Make sure that you're executing trades. But they also have a very specific job as a floor trader manager. You also want to make sure that the firm in general is not over risk. So you can't have all the traders in your floor trading the same asset. If you're all wrong, you're all screwed. So you need to divide your team and have someone hedging on behalf of others. It's like a complicated thing, but it's basically the supervisor of all traders, right? So this is the editor in the book, right? It's a take from scientific Taylorism. Taylor was this historical guy who created a system in the factories back in the day, 1934, 1923, etc., when Fordism became a thing. It was to break down the work, really isolate the individual into smaller duties, right, so that you can control them, right? It's a terrible form of management, but on a trading floor, it seems to work wonders, right? So Addison sat down next to me. Price was nearly exactly 119. And then etc. etc. Then Craig says, oh, heck yes, for sure. I wanted to put my own money in this trade. I told Anderson all of this. He didn't say a word for the entire time. Just listened to me make a speech. He didn't even ask any questions. I love that man. As soon as I finished, he took my keyboard and made the trade. Harry says, so you bought it at exactly 119. Well, Addison did, yes. And then I bought more after that at 11950. 5 million more euros worth, and then 10 more at 120, right? And then again and again, and until I put 500 million in the trade. Remember, he's converting lots. So it's not that his capital was 500 million. It's how much he had used the broker to leverage that stuff, right? Remember, you buy units in the currencies. So one lot is about 100,000 units. And then if you use a smaller lot size, you start reducing those units, right? Don't get confused there, right? In the trade. And I was so sure of the trade that when any pullback, even slight ones, I added winning positions. Pullback retracements. He was watching his chart for retracements because he was so sure of the trend where the price was going. So retracement didn't spark fear in him to get out. Retracement meant opportunity to buy low again. If you know what you're doing, if you know, this is not for everyone. This is for someone who's mastered their art, done their research, looked left, understands their strategy, talk to their community about price, right? You've heard what he did before he got here. So every time there was a pullback, even a slight one, I added to my winning position. Harry says, then what happened? When did you exit the trade? Craig, I closed it about 2 months later. Swing traders, retail traders, you have to understand there is more money in risking less in terms of your lot size and holding longer than there is in over risking and getting stopped out and blowing accounts. There is more money in trading when you start to think about how you think about your 8 to 5. You clock in every day at 8 to 5. You clock out on Monday. You clock out on Tuesday. You never go to your boss and ask him for your salary. Your salary is paid at the end of the month in 4 weeks. And all of you are patient enough to wait. Let price run. Let price run, right? Remember, lesson one, learn to write your profits. So he closed the trade in 2 months, but that's not the lesson I want to draw out yet. There's still more. It immediately moved about 300 pips in my direction, and I felt like the I'd smartest guy in the world. Then it backed off a bit and it bounced around in October and most of November. Then in the first few days in December, it skyrocketed. My positions were worth millions of dollars, and I nearly threw up. I literally nearly threw up, and it's a crazy experience, especially your first big trade. Your very first big trade is a crazy experience. I threw up on December the 2nd, 2002. It moved 200 pips upward, breaking all resistance. I didn't sleep for 4 days for more than a couple of hours at a time. I glued my face to the charts at work and called in for calls all around the clock. So I kept watching this trade and babysitting, which is something I highly do not recommend, right? And then Harry says, so why were you concerned? And let's just quickly take time. So if you see there on page 36, you can see the chart, and the chart there is showing you where Craig buys. All right, so this is Euro JPY on the daily time frame. Interesting, right? On the not H4, not H1, not 15 minutes, on the daily time frame. And if you understand 365, you see you've got a bullish engulfing pattern there. You've got an uptrend that's been confirmed, and data is literally lined up at 119. So that's where he buys. Now on page 37, as we continue to read, right? So he says, Harry asks, why were you so concerned? He says, I couldn't stand to see all that money in profits and not take it. So he'd been holding for 2 months, and now it's like really big, and he doesn't know what to do. Should I close? The temptation to close. It's not greed. We'll get to that point, right? Anyways, money and not take it. I had sat on my hands with the trade that was up by $1 million or so, and then all of a sudden, every trade moved in ridiculous, super profitability. Never before had I seen that much money in one place. I understood that if the currency pair fell down again, I would lose all that money. It was nearly the end of the year, and I was thinking about what kind of a bonus I would get. Traders get paid a percentage in salary, but also performance. So remember, when you're managing your flows, your flow traders, and when you're managing yourself, you have to be very careful about understanding what motivates you as a trader, or understanding what motivates your team. If you're paying them a high salary, like so when we were working at Allen Gray, we had a good salary. It was fair. I was an analyst anyways at that time, so it wasn't that crazy. Then as a flow trader, a good salary plus a performance bump, right? So traders who get motivated by performance bumps generally take bigger risks most of the time, right? Because you get a cut of the big share. Just remember that, and you need to figure out what motivates you as a retail trader. All right, you really have to break this stuff down analytically from the jump, so that you are not caught on the wrong side of your emotions, your perspective, a blinker in what you see in price, right? So the end of the year, December, it's time to clock in those profits, and you're thinking about, well, if markets all of a sudden fall, I'm gonna lose all these profits, right? And this is not how you used to think 2 months ago when he got in. When he got in originally, every single pullback didn't strike fear in him. Every single pullback was an opportunity to buy more. But now that price has rallied properly into super profitability, now that fear is creeping in. Like, okay, I might as well close now. I don't wanna handle another pullback, right? Because it's gonna reduce that big balance. I'll lose it all. It was nearly the end of the year, and I was thinking about what kind of a bonus I could get for having done a $10 million trade. I had taken some other trades during this period, lots of short-term trades, and all of those netted out in break even. This was my only huge winner. It got blinkered by one trade. All right, so that's why I love sit and forget, right? So all the other small trades he kept taking while he was holding this one, a lot of them were emotional trades. They were breaking even, he was losing a little bit of money, and so all he had after 3-4 months of trading was this one big giant trade. And if he lost that one big giant trade, it would wipe out, all his gains for the year, essentially. Right, so Harry says, so you closed it? Yes, super yes. They stood up and gave me a round of applause on the floor that day. Everyone except Anderson, the floor trader supervisor, the manager. This must have felt really good, Harry says. My first trade was a winner too. I remember that feeling. Why didn't Anderson applaud you? Didn't this trade make him a ton of money? Craig, oh yes, I'm sure he looked good for having hired me, but he understood that I just cut off a huge position. You gotta understand how these big guys think. Institutions think differently about this market. And when you start to think like that as a trader, you know, things change completely. The game changes for you. So Anderson is not impressed because he understood that I just cut off a huge position that was totally profitable and that had taken me months to build. That's the important part. If you're going to become a swing trader like me, you have to remember a lot of the work is done at the entry of your area of value. So let's say you enter on a demand, like on page 36 there. That's job number one. Job number two is you're going to have to wait for price to create continuation patterns, not PCPs, not potential continuation patterns, but actual continuation patterns. You need price to do that. And that can take time because you need maybe 3 or 4 new fresh demands to be created on the daily time frame. That might translate to 1 demand on the weekly time frame. You need about 2 weekly demands on the weekly time frame to continue this trend for a long time. So that's at least 3 weeks of building a position, just building it before it really runs, right? If you catch it. So if you catch an entry point on a monthly demand, if you've been following my channel, you know what I'm talking about, right? And then you have to allow for continuation patterns to create, for price to pull back and leave on a daily time frame, which is a 2 to 3 to 4 week process. And you need at least 2 valid weekly demands higher than your entry time frame, right? That's what you call building a position, and that takes time. And so Edison understood that, look, man, you've just begun. You've been holding this trade for 3 months. You think that's it? No, you've actually only just finally secured an entry point. So when price was to ever pull back, it's got multiple weekly demands to break through. So you are safe now. You've just built your position. Now it's time to hold it, right? So Edison understood that I just cut off a huge position that was totally profitable and had taken me months to build. Right? Craig then goes, you know, and then Harry says, it seems greedy to me, right? This is what a lot of people assume is greed in trading. And then Craig says, this is it, this is a lesson. Getting the most out of your best trades is not greed. It is being smart. You let your worst trades run to stop loss because you're supposed to, right? You're supposed to trust the stop loss, put it there, calculate the risk. But we always allow our stop losses to get hit. Why not let your best trades run into mad psychotic profitability? And that's my question for you today. What is stopping you from actually understanding the trend and price and letting your trades run into insane profitability? If you don't know that, by the way, I should have said at the very beginning, there's a link down below this video. I will buy anyone who puts in their details an e-copy of this book, right? That's my gift to you. I will buy it. It's up on Kindle. I'll send you a copy, send you everything, your copyright receipts, blah, 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 for anyone who wants a copy of this book, if you don't have a copy of this book yet, all right? Now, he says, why not let them run? And then Harry says, you have a point. Did this one go up even further? Did you regret closing it? Craig says, you better regret it. I let my emotions ruin the trade. This is a $10 million profitable trade that was closed. And he believes reflectively, right? I let my emotions ruin the trade. I picked 131 as my profit target with a round number 365 traders. Don't forget the 365 numbers. Institutional trading power, right? I had picked 131 as a profit target with a round number, and the point of support and resistance at the pair had stopped at 1997. So he was looking left to see where last that trade stopped. At 1998, 1999, it got off that high. It will be the first time in 3 years that it reached that level. It would have stopped there for sure. Did it get there? Harry asks. Craig, damn right it did. If I had held on, I could have made a lot more on that trade. I would have had to hold it for 4 more months to get there, but I would have made an additional $30 million on this trade. Forget a round of applause. I would have been promoted to managing director or something wild like that. It would have been a monster trade. I really stepped on my own foot on that one. Ride your profits, Harry. That is the lesson here. Learn to ride your profits. All right, and as we wrap up, here's page 38. Look at the where Craig bought, where Craig panics, right, and sells there, just there. I'll draw a line for you guys, just there, December, that's where he sells panics. And that is an interesting perspective. And I really thought I should bring this up to you guys and really consider this. Don't step on your own foot. If you don't know what you're doing, of course, there's a different link somewhere down below. Join 365. We teach you supply and demand so you understand where price is going. That's number one, because you don't know. If you don't know, you don't know, right? So you don't know when to get out, you don't know when it's safe, you don't know how long price will run. But if you understand where price is going, it changes the game. My name is Leroy James Maisiri. I'm the head trader of 365 Trading Academy. Thank you for liking, thank you for watching, thank you for commenting. Don't forget, if you want a copy of this book, free gift, just hit me down. I only need your name and your email address or something like that, and we'll buy you a copy. Read the book. Only ask for the book if you're going to read the book. Please read the book. It's an incredible book. It's filled with life experience, real life scenarios, and incredible lessons. But come back to this channel, because I'm going to be breaking down this landmine, this gold mine here of information. Shake my hand, and I'll see you in the next one.